This is a market update on the health of a few major markets that affect the United States and scrutinizing various technical and fundamental phenomena. When analyzing technical economic data, it is best to look for the factors that drive long-term trends and to pinpoint where we are at as a society in the long-term picture, because the long-term drive the shorter cycles and trends that put greater perspective on the economic structure. Then focus on the drivers of the inner trend that support the long-term trend to see if we are reversing or consolidating, and to get an idea on where the economic trends might head in the future. It is very likely that we are in the middle of a deflationary cycle that is normally preceded by a euphoric phase and followed by an industrious economic war phase. The major phases our economic social order goes in and out of is mainly attributed to monetary policy and debt. Every major economic trend since the mid-1700s has been caused by the change in monetary policy and debt first, then followed by governmental policy and technological advancements. Therefore, the monetary and debt situation that affects the major trends will be mostly examined. When looking at monetary policy and debt, it is obvious that some major imbalances, such as the rate at which debt is accumulated in combination with monetary expansion, to the creation of real assets and private sector financial and economic health. The system historically has turned direction to find an equilibrium between imbalances, as with all systems in science. The center of the imbalances is driven and derived from a zero interest rate policy brought on by the Federal Reserve. The Central Bank of the United States is leading the way by engaging in a zero interest rate policy followed by most developed economies for global stability, which has put in play a paradigm of countries globally engaged in a zero interest rate policy, which was done to prevent the deflationary phase that the collapse of the dot-com bubble and the financial market crisis in 2008 had set into motion. This zero interest rate policy is a two-sided coin, with the face giving us good economic outcome that unfortunately comes with a tail end that will eventually take us through this reversal or consolidation period, showing in patterns of various indexed trends. During the time of zero interest rate policy, historically low mortgage rates led the housing market to show some positive signs due to Federal Reserve purchases and bailouts. But for the banking system to be truly bailed out and recovered, stabilization of the housing market will be more than likely required, and the zero interest rate policy would need to end without economic collapse. The housing market is showing a mixed economic picture depending on perspective. For one, putbacks are still rising and refinancing has taken its toll, which runs to increased risk of a downward shock that promote more stimulus from the Federal Reserve if the housing market takes another dive, which the only thing keeping it afloat are the zero interest rate policies and the Federal Reserve purchases, which give false economic indication and indicators. The United States income have not improved to stimulate sales, and until it does, the real estate market will be on life support, covered in confusion of false indicators, but the drivers of the false indicators are the mechanisms that are promoting positive signs developing in the housing market. The valuation of homes sold back to its historic trend line due to inventory stabilizing in the housing market. The inventory of house stabilizes the property value of the communities of the stabilizing inventories. Defaults and foreclosures has bucked their trend but is in still dangerous levels, which is one reason why the Federal Reserve is continuing into quantitative easing program number 3, which help keep interest rates low. Therefore, mortgage rates decline, which helps the real estate market. It might be possible for the Federal Reserve to keep the stimulus going till income catch up with housing through inflation. Dropping the value of the dollar through monetary expansion makes the value of goods increase, with income normally lagging behind, while real estate normally becomes a poor investment. With the United States housing value still overvalued compared to the affordability of housing, inflation could work as a stabilizing mechanism, making debts from the national level to personal more affordable when interest rates rise. At this point, banks should be able to make profits and expand credit without schemes and derivative swaps that exuberate imbalances derived from low interest rate policies. After the banks begin to stabilize, the Federal Reserve could begin to draw back the extra liquidity with rising interest rates combined with government austerity measures. For this situation to be positive for the United States economy would depend on the banking system not being in a collapsing situation due to the dependence of multiple price manipulation and the expansion of the derivative bubble of approximately $1 quadrillion, mainly in interest rate swaps, and an investment community willing to buy treasuries back from the Federal Reserve, in combination with a commodity sector, particularly oil, that can supply global needs without disrupting the petrodollar, causing supply inflation instead of monetary inflation as the enemy of the US dollar, since the commodity sales mainly in oil is the mechanism that keeps the US Treasury market thriving with liquidity and dollar strength. Many believe that the derivative bubble is another scheme set in place to keep banks afloat and profits flowing with no conscious care of what the outcome would be, as in with the housing bubble. During the housing bubble, the banks kept the economy afloat from the deflationary force brought upon by the dot-com bubble by fattening their pockets and engaging in credit default swaps to mitigate risk and make profits during low interest rate environment. This time around, the banks are helping the economy stay afloat from the deflationary force from the popping of the housing bubble by engaging in interest rate swaps to make profits and to mitigate risk, as with the housing bubble and credit default swaps. As with the housing bubble, the scheme was able to push forwards as long as housing values were to keep rising, where in this situation it is a good possibility that the only thing keeping this quadrillion-dollar bubble from popping is the downward trend in global interest rates, on top of a treasury bond seem dependent on a constant downward trend in interest rates to keep investments in treasuries flowing due to the many profits made off the increase in bond price, while the other end of the seesaw is its falling yield. The derivative bond and debt bubble could strike a severe blow to the global economy, sparking a major deflationary phase which could prompt the policymakers to engage in a major inflationary policies that may look like or become hyperinflation. Many are debating whether this is an economic recovery or the eye of the storm with much more pain to come, which is why many markets are showing consolidations or the possibility of reversal within their chart patterns. By analyzing market valuations via trend patterns and cycle analysis using various data to gauge market psychology through the understanding of herd behavior with the combination of fundamental analysis help illuminate what is transpiring in the market. Some commonly used market barometers are the NASDAQ, S&P 500 index, and the Dow Jones Industrial Average. These indexes and averages are used with the assumption that when they are doing well, the economy is doing well, and with the occasional ability to act as a forward-looking indicator, turning direction before the overall economy. All of the broad market averages took a heavy decline in 2008 and had bottomed out in 2009. From there, an obvious uptrend can be observed. When examining a trend using technical analysis, the two primary objects to scrutinize are price and volume, and to gauge them in terms of trend. What is not so obvious to the untrained eye is that the volume has been trending downward since the crash of 2008 till this very day, in the major averages commonly having its heaviest volume days on the corrective sides of its uptrend. This is commonly a sign of the trend running out of steam unless the uptrend is part of a continuation pattern. In the event that this is a continuation pattern, this uptrend possibly can go on for much longer, with the main driver possibly being monetary inflation. Under normal market conditions, I would bet that the market will correct at this point, but the actions of the Federal Reserve can take is only left up to the imagination, which makes it possible to create a false market anywhere in our capitalistic system. The Dow Jones Industrial Average, NASDAQ Composite, and the S&P 500 Index are showing uptrend triangle continuation patterns, which are continually showing signs of breaking out on the upside, or have broke out on the upside and starting new uptrends. The NASDAQ has already broken out on the upside, which the Dow Jones Industrial Average and the S&P 500 Index are breaking through their resistance lines. Looking back at the trend direction, the Dow Jones Industrial Average has just completed a 5-wave Elliott uptrend, and each of the legs of the 5-wave uptrend is composed of a 5-wave pattern itself, which suggests that this is not just the end of the upwave that has been in place since late 2011, but the end of the upwave that started in 2009. If this is the case, then it is possible that the topping patterns are forming in the averages, such as with the possibility of a triple top in the long-term chart of the S&P 500 index. Some believe that we have a mafia-style banksters that are manipulating the market in interest rates, gold, silver, oil, and real estate and equities. And that is why the averages have been able to climb in a situation where the revenue and earning per share has been declining, and equity funds has had a negative outflow versus bonds while enduring a steadily declining volume. In combination with an economy that has not improved its underlying fundamentals of what caused the bailout situation to occur, and a labor base that's struggling to keep its service-based consumerist economy afloat. Americans will not believe in the media source recovery till food stamp and unemployment benefits decline without austerity measures and interest rates normalize. American purchasing power normally go through cyclic phases of up and down trends of approximately 7-year periods that can be examined in long-term consumer confidence charts. And at this point, consumer confidence is almost up to its historic recession levels, with the increasing possibility of a cyclic downtrend on the way. Not to mention that the government is now starting to engage in contractionary policy while the economy is still on monetary life support. If the market averages continue forward, more than likely the trend is inflation driven due to the underlying factors having poor fundamentals on the balance sheets of most corporations and the continuous expansion of the monetary base through zero interest rate policy. And speaking of inflation, the best barometer used is gold and silver, the United States dollar index, and oil. Silver and gold has been a good gauge of the health of expandable monetary supplies for centuries, and just recently oil has jumped into the arena. Commodities such as oil, gold, and silver have been on a decline, making some people suspect that the commodity market has started a downtrend in its valuations. This would be possible in the presence of a major deflationary force, which at this time the most likely scenario that will cause this cascading effect to transpire would be the collapsing of the banking sector that would freeze their liquidity, like what started to transpire in 2008, which caused commodities to decline and overall economic activity, which is what the inflationary zero interest rate policy is trying to prevent, which tend to make most believe that the bull market in commodities is not over, but it is still a slight possibility depending on actions. Silver and gold are showing possible outbreaks on the upside of triangle continuation patterns in the chart patterns. If the uptrends don't take hold, then it could be forming a channeling pattern, which is a continuation pattern as well, as long as the long-term uptrend in gold and silver holds. Continuation patterns such as triangles normally are constructed during time periods of indecisiveness of direction and underlying fundamentals of the market object in question. And when the US dollar index, oil, silver, and gold come into play, monetary data is the main object to be scrutinized. When you look at monetary policy, the Federal Reserve has not stopped expansion of its monetary base, and Wall Street banks are still reliant on a continuing downward trend of interest rates to keep the greedy game of profits flowing in interest rate swaps that amount to extraordinary exposures amounts. Since gold, silver, and oil normally runs higher when larger amounts of cash begin to chase an amount of goods that has not expanded at or near the pace of the monetary expansion. Therefore, these possible continuation patterns lead me to believe that the investment participants in the monetary market have not come to a conclusion of direction, but will inevitably show its true colors when it trends one or the other direction out of the triangles, which gold and silver seems to already has broken out on the upside but has not truly confirmed, and oil is still within its triangle confinements. If oil runs higher, breaking its possible continuation pattern, beginning a new bull market, marching oil towards $200 could run the danger of pricing itself out of the market for a large portion of global demanding public. This situation could directly affect the valuation of the dollar and threaten the economic national security of our nation. Oil, as well as most other commodities, are traded in U.S. notes only, with the exception of Iranian trades, which the sale of oil provide the USA with liquidity and strength in its treasury market, which enables the United States to engage in a zero interest rate policy, with the banks profiting off interest rate swaps and free cash, which helps banks build a mountain of derivatives amounting in the hundreds of trillions by U.S. banks alone to try to keep the status quo running a little longer. Therefore, if price inflation of oil prices out the market that the United States export inflation to, it would put upward pressures on interest rates, kicking in a vicious cycle of inflation and higher interest rates no matter what policy the Federal Reserve decides to execute. At this point, Treasury bond investors would be discouraged from purchasing bonds at the risk of increasing interest rates. Also, would put upward pressure on interest rates through self-fulfilling prophecy. Unfortunately, a large portion of derivatives is mainly accomplished by leveraging, creating counterparty risk exposure amounting into the high trillions, and also given the possibility of derivative default if interest rate swaps market as selling bonds become harder, feeding the cycle of upward pressure on interest rates. In the event of rising interest rates, the ability of financing the national budget becomes a problem from trying to pay interest payments on the United States' $16+ trillion debt, creating the possibility of various defaults, also putting upwards pressure on interest rates. It's all about where the large cash is going to run when time finally tells. Oil, silver, and gold breaking out on the upside, along with the market averages breaking out on the upside, and they can also fall on the downside under this situation, would be a sign of inflation, which is dangerous and probably most likely. Oil, gold, and silver, and the market averages breaking out on the downside would be a sign of collapse towards deflation, as of what happened in 2008 that prompted the Federal Reserve to engage in its zero interest rate policy. If oil, gold, and silver break downwards and the market averages break upwards, it could be a sign of stabilization only if the United States could walk a fine line of inflation and higher interest rates, and this scenario being very dependent on the financial sector not being propped up by a pyramid scheme, as which is very possible by the size of the derivative swap market. And in all three scenarios, the dollar should mirror image the commodities of oil, silver, and gold, along with most other nations, unless some major international event unfolds which could change either three scenarios. Thanks for watching and listening. Goodbye.